Good afternoon, everyone, and thanks for joining us today on our webinar about trust and estate planning for tax-efficient wealth transfer. My name is Thomas Seneca. I'm the founding partner of TM Wealth Management, and I'll be kind of going through all the materials with you today. Unfortunately, we won't be doing any Q&A, but if you do have questions after the fact, feel free. We're happy to schedule some time, answer your specific questions so you feel you get the information that you need to make the best decisions for you. A couple of quick disclaimers. We're going to talk a lot about some legal issues today, topics. We are not attorneys. We're not tax experts. And so anything you hear or learn throughout today, please make sure you review that with your tax or legal professionals as well. Just a little bit about me. Started my career on Wall Street, working for Goldman Sachs and Deutsche Bank. While I enjoyed that, I learned two very important things about myself. One, investment banking is not conducive to a family, and that was important to me. And two, I needed to feel like I was doing something that mattered, that had an impact. And while you can argue that an IPO or an M&A transaction has an impact, it wasn't the kind of impact that I wanted to have. So I transitioned to wealth management, where I'm able to still be involved and engaged in the financial markets and help families and individuals make good financial decisions so they can have the greatest positive impact on the people and causes they care about most. So I also want to give you just a brief overview of our firm. Everything you need to know about us is in our logo. Independent, having worked on Wall Street and for large, what are called bulge bracket investment banks. It was important to me that we stay independent. We work for our clients. There's no strategy or mutual fund or investment that we are forced to promote or put our clients in. We remain independent and work for our clients. Secondly, it was important for us that we remained relatively small, boutique. I saw on Wall Street that there were firms that had thousands and thousands of clients, and the advisors just couldn't consistently add value to that many people on a regular basis. And so it's important to me that we stay small enough that we can really go deep with our clients to better understand what their needs are and meet those needs rather than trying to do things based on volume. Third is wealth management. It's important that we look at everything. So as we talk today, we're going to be talking about estate planning and taxes. You may think, what is a wealth advisor doing talking about those two topics? It's because we look at everything. We take a comprehensive view of everything that's going on in our clients' lives. We've got a broad base of expertise, and we know when we need to bring in the specific experts, whether it be legal or tax or otherwise. And we can function as that quarterback for our clients, coordinate all the moving parts to make sure it's as efficient as possible and allowing them to spend the time on the things that matter most to them. And then lastly, it's important that we function under the fiduciary standard. We have a legal obligation to do what's in our best, do what's in the best interest of our clients. And we think that's an important element to share because not everybody has chosen that standard. And so as you look at getting financial advice, you want to make sure that you're working with a fiduciary. And as we look at kind of the comprehensive wealth management, estate planning, tax planning, all of that is part of a comprehensive wealth or financial plan. And so that's why we spend time talking about it. And when you get ready to do some estate planning and tax planning, one of the first questions you're going to get asked is, what do you have and how are they titled? And so a financial plan really is the first step in any tax planning, estate planning, anything else to make sure that you've got the assets that you need to live out your life, but then also to understand how it's titled and how it may need to be reconfigured to meet some of the goals that you have in terms of what to do with the assets at the end of your life. So we'll talk a little bit about estate planning and tax planning as well. So this is one of my favorite stories. When Shaquille O'Neal was traded from the Orlando Magic to the Lakers in 1996, he signed a contract for $120 million, 7-year contract. Just a little less than $20 million a year. And as soon as Shaq signed that contract, he got to LA and went out that very first day. He bought 3 Rolls Royces, bought a house, spent nearly $9 million in a day. And as he was going through all this, his accountant called him, his agent, and said, hey, Shaq, you need to slow it down. You've only got $1 million left for the year. And Shaq didn't understand. He's like, what are you talking about? I get about $17 million a year, and I've only spent about $9 million. and his accountant was like, hey, well, there's taxes, both federal and state. You're going to hit with taxes, so your spendable is closer to $10 million a year, not the 17. And so that was a real wake-up call for Shaq. And so for all of us, as we understand, it's not how much you make, it's what you keep. And part of the challenge that we have right now is in our country, we're spending a lot of money. And this graphic's a little bit out of date. This was back in about 2015. And it was illustrating that our entitlements and all of our net interest, we would exceed our revenues back in about 2030. And we've already done that. In 2022, government spending was 36% of gross domestic product, and revenue was only 19%. So we are spending more than we are currently taking in. So one of two things has to happen in the future. Either Congress and Washington has to stop spending so much, or tax rates have to go up. And the easier thing for them to do is to increase taxes. And so that's why we're spending at our firm a lot more time on the tax planning and looking at how we can become more tax efficient for our clients. One of the other things to be aware of is there's this greatest wealth transfer that's coming. And when we talk about assets by generation, right, baby boomers have about 79, $78 trillion in assets, and that's going to begin to start to transfer to some of these other generations. And so, that 80, $78 trillion is going to be going to the millennials and Generation X and the silent generation. And so they may be unprepared for that, but there's also going to be significant taxes associated with it, estate tax. And so we want to be aware of that and be prepared. And that's why we're doing this webinar on estate planning and asset transfer, how to be more tax efficient. And so as you start to think about estate planning, it's not just about the transfer of assets. It's also, doesn't everything go to my spouse? How do I preserve more of my money? Do I have the right beneficiaries on my account? And all these other questions that we want to answer as we put together a comprehensive estate plan. And I'll run through a couple of things around a comprehensive estate plan. So it'll give us a baseline around what we need to have in place to be then transfer assets tax efficiently. And you think about why a plan, right? It's about the people and family you care about. It's about charity. It's about having a peace of mind. And in the end, that's really the reason why we want to do some planning, because an estate plan is your last demonstration of love to the people and causes you care about most. And so that plan helps them prepare for what's next. And your estate, you want to do the math. Your estate is really your assets minus your liabilities, so that you know where you fall in certain of the limits and exclusion amounts within the tax code. And estate planning really is just preparing your estate for an orderly and efficient distribution upon your life and upon your death. And estate planning deals with everything: financial planning, retirement planning, business succession, charitable, medical, disability, legacy, and gift planning. So it encompasses a lot. And this highlights, who needs what, right? Everybody needs a will, asset titling, power of attorney, advance directives. Some people might need life insurance, and some people might need trusts and estate planning. And a properly crafted estate plan can, help you get a lot of benefits. And primarily, it's avoiding probate, which is the court process demonstrated for how to distribute assets when you just use a will. It also can allow you to maintain control over the estate and protect inheritance from creditors and divorce, which is a big one that our clients are focused on as well. So here's the kind of key elements and documents for a basic estate plan. The distribute estate documents are your last will and testament and potentially a revocable living trust. The disability planning is financial power of attorney, medical power of attorney, or advanced medical directive, and a living will, right? So these are the disability plans. You're still alive. Who gets to make financial decisions? Who gets to make medical decisions? And how do you want things to be decided while you're still living, but maybe incapacitated? Meaning, do you want to receive life-saving medical treatment? Your will and a revocable living trust are, that's how you distribute the assets once you're gone. And we won't spend a lot of time going through all of this, but if you would like the slide, we're happy to share those with you. But really what we want to focus on today is this idea of how do we now start to transfer these assets to avoid certain tax implications. And so this graphic here just illustrates that the current estate tax exclusion for an individual is $13.6 million. So what that means is if you pass away today and your estate value is below $13.61 million, then you're not subject to the estate tax. Now, that doesn't eliminate income tax for those that receive the assets potentially, right? So if you transfer $1 million IRA to one of your beneficiaries, that's not subject to estate tax, but when they take the money out, they're going to be subject to income tax. And on the other side, gifts, this year you can give $18,000 to an individual and not have it impact your lifetime exclusion amount of $13.61 million. So that's a way to get money out of your estate and not have it be taxed from an estate tax standpoint, that $18,000 a year. And that's, you can give that if you're married, you and your spouse can give $18,000 each to one individual. And so if you've got, married kids, each of you can give $18,000 to your child and to the spouse and to grandkids, and anyone you want, to start to get money out of your estate. And that's a way to start having an impact with your resources now, rather than having to wait till after you're gone. Another element to be aware of is states have both a estate tax, and some states have an inheritance tax. And for those of us that live here in the Washington, Maryland, DC area, Maryland has both a estate tax and an inheritance tax, which means that if you inherit money in Maryland, then you will also be subject to an inheritance tax. Now, there's certain exclusion amounts and limits and everything else, but just be aware that certain states like New Jersey, Delaware, Pennsylvania, Kentucky, Iowa, Nebraska, they all have an inheritance tax. And then some states like Washington, D.C., and Maryland and New Jersey and New York and Connecticut, all the green are estate tax. Virginia has neither an estate tax or an inheritance tax. So just something to be aware of as you start to think about how am I going to transfer these assets tax efficiently. So 7 tactics that could reduce taxes from your estate. First is to make sure both you and your spouse make full use of your estate tax exclusion. That's that $13.61 million. Unfortunately, in 2026, unless Congress acts, that number is going to go down to about $7 million per person. And so in this area, in the Northern Virginia, DC, Maryland area, you can run into, if you've got a house, significant IRAs and 401ks, you might start to bump up into that exclusion amount. And need to do some more advanced planning, but make sure you use your full estate tax exclusion amount. Think about establishing a gifting program. Once you've gone through our financial planning process and made sure that you've got enough assets for your life and your lifestyle, then you can start planning around what do we do with the assets that might remain. And it may make some sense to start doing some gifting now rather than waiting till after you're gone. Think about donating assets to charities. So from a tax efficiency standpoint, it's much better to donate a traditional IRA to a charity than it is outright cash or taxable stocks or a Roth IRA. The reason behind that is because charities don't pay any taxes. So if you have a $500,000 Roth IRA and a $500,000 traditional IRA, and you want to do equal gifting between your charity and your child, well, then it would make sense to give the traditional IRA to your charity and the $500,000 Roth IRA to your child, because now the child's going to receive an asset income tax-free, and the charity is going to receive that IRA, which has deferred taxes, which they don't have to pay because they don't pay income tax. If you have life insurance, that might increase your estate value and bump up against some of those exclusions. You may want to place your life insurance policies in a trust. May make some sense to place a residence in a trust to get it out of your estate. You can still live there, but now it doesn't count towards that lifetime exclusion amount when you pass away. If you have business interests, you need to look at some specific structuring for succession planning. May make sense to form a family limited partnership to be able to use those assets and as a gifting vehicle. And then lastly, leverage your generation skipping transfer tax exemption. If your kids are totally financially self-sufficient and they don't need to receive the assets, Maybe you gift those to, grandkids or great grandkids so that they can benefit from them rather than your kids having to deal with potential estate tax or gifting tax once they receive your assets. So there's a lot of things that you can do to prepare for a efficient transfer of wealth. And these are just 7 tactics that we would recommend. And we encourage you to reach out to us and spend some time with us so that we can help you craft a comprehensive financial plan to meet your needs, give you the insights that you have a secure retirement, and then help you identify areas where you might be able to be a little more tax efficient, not only in your own use of those funds, but also in the transfer of those funds. We thank you for spending some time with us today. We hope it's been valuable for you. We look forward to interacting with you. If you have any questions, please reach out to us. We're always happy to spend some time to make sure you have the information to make the best decisions for you.